What's up everybody, Nate here, and it is officially September, so I want to go over a few key dates that you need to pay attention to for this entire month. And I want to talk about September for markets just in general, because out of all of the months that we have, September is typically the worst one for every single market. So today I kind of want to talk about why that is and why things might be extra bad this September. All right, so let's kind of break this down. So September is usually a terrible month for the stock market. In fact, since 1928, only 44% of Septembers every single year have produced a positive return for the stock market. On average, the stock market usually goes down by around 0.5% in September. So what the heck is going on here? Are investors just sad that summer's ending? Well, kinda, but there's a lot more going on here. So September is near the end of the year, obviously, and a lot of businesses and companies take this as an opportunity to rebalance all of their financials for the upcoming year. That means, how are they going to make more money? How are they going to cut costs? And what exactly do they need to do in order to, well, continue to be profitable in the next calendar year? Usually what they find out is that they need to cut costs. So they look at everything they're spending money on, whether it's people or products or services, whatever it might be, and they start cutting. They start cutting really hard, and they start dropping services altogether. So they start cutting costs and they stop spending as much money. Now that looks really bad to investors and the stock market because everything before was kind of artificial. A lot of investors went in to a lot of these stocks thinking that they were going to have all of these services and all of this spending and that they were going to continue to grow. But now at the end of the year, these businesses are basically taking their cash and running. Not only that, but they're cutting costs so they can start preparing for the holiday season. November and December specifically are huge spending months for businesses all throughout the country. We're talking ad dollars, we're talking inventory, and businesses start to prepare for that. They start to build all of their money up so that way they can spend money on advertising, and they start building their inventory for the holiday season, and they need money in order to do that, so they've got to cut a lot of costs, and well, they've really got to rebalance their financials. And then lastly, the reason September is a bad month for the stock market is kind of because, well, investors make it a bad month. Ultimately, it's really psychological. A lot of investors know a lot of these things are coming. They know that businesses are going to start cutting costs. They know that all of these things are happening, so they just pull their stocks out. They start selling because they just believe and they think that everything is going to go down. So there's a good portion of that psychological issues going on in the stock market during September. Now, that's not to say that any of this is actually going to happen, but that's what usually happens. It's September, and then as the year progresses and we hit the end of the year, well, December is usually a really good month for the stock market because all of these businesses are showing their reports and they're showing that they've cut costs and they're showing of how much money they made during the holiday season. A lot of investors love that and they start to pile in. But this September is going to be very interesting, and I want to talk about some key dates that you need to pay attention to this year. So this September, obviously the first date that you need to mark is September 5th. That is Labor Day, and the only thing that's significant about that is, well, the stock market is going to be closed. So if you have any trades, well, you probably should have made them on Friday. That means you can really start to expect all of this pandemonium to begin Tuesday, September 6th in the United States. Now on to some actually major dates. So the first major date that you need to pay attention to is September 13th. This is the August CPI number, so the Consumer Price Index for the United States that measures inflation. Basically, the Consumer Price Index takes a basket of all goods and services in the US, and it shows us how prices are progressing. Are they going up or are they going down? If they're going up, then you have high inflation. That means prices are rising in the United States. This one is going to be very significant because inflation has been going up and up and up, but many people actually believe that inflation peaked in July 2022. It was only 8.5%, down from 9.1% in June. And we could actually see August CPI or inflation go down as well, and the key contributing factors to that would be energy not really going up. Energy and things like housing, well, they have a huge portion of the entire consumer price index. Energy in particular is around 1/3 of the entire index, and that shows that most Americans spend a lot of their money on energy every single month. With energy, though, not really going that much higher in August, well, that means that, well, inflation probably didn't go up either. The housing market also cooled off a lot, and you saw a lot of prices go down in many different markets all throughout the US, so that that helps consumer inflation as well. But expect some things to continue to go back up, like food and shelter costs specifically rising in the US, like rent is still going up, and the cost of grocery bills for everyday Americans is also rising, so that's going to contribute to inflation too. But the biggest reason why this inflation report is so important is because of the Federal Reserve. Now, we talk a lot about the Federal Reserve on this channel, but this next FOMC meeting on September 20th and 21st is going to be huge. Throughout the entirety of 2022, the Fed has pretty much been raising their interest rates every single chance they've gotten. And right now, their federal funds rate sits at around 2.25 to 2.5% in the US. That's considered a neutral rate, meaning it's not really hurting our economy, but it's not really stifling growth either. Depending on what the numbers are and depending on what inflation is, well, that's going to guide the Fed's decision. Are they going to continue to raise rates aggressively like they have over their last two meetings, raising them by 0.75%, or are they going to, well, take the foot off the gas a little bit and only raise them by a 1/4 percentage point or a 1/2 percentage point? Depending on what the Federal Reserve does will basically show us how they view inflation is going in the US. If they're not super aggressive, then we know for them inflation is going to come down very soon, and well, they're not taking it very seriously anymore. But if they raise rates aggressively, like 75 basis points or more, then we know that inflation is way too high and it's probably going to continue to go up. That's why they need to get aggressive. This signals to the rest of our economy, and it's a psychological thing. It's really about expectations here. If the American people see the Federal Reserve raising interest rates aggressively, then they're going to get scared and they're not going to want to spend. And the same thing is going to happen with the stock market. However, if the stock market is going to look at either things, and they're not going to like it, because with interest rates going up, that's going to hurt businesses. And it's also going to hurt consumers alike. So they don't really like it either way. And they just like it if the Fed would stop raising rates altogether. But this is an opportunity now for the Federal Reserve to take their interest rates beyond the neutral level, and that's going to have an effect on everything in our economy. Like I said, with them raising their interest rates, that hurts businesses, and the way that it hurts businesses is through investor liquidity, interest, and debt. In 2020 and in 2021, investors had a ton of money because of the quantitative easing program from the Federal Reserve. They were buying billions of dollars every single month in assets like bonds and treasury notes. That led to an increased government spending a lot more money, but it also led to, well, investors spending a lot more money. These businesses hired a lot of people, they improved their inventory, and business growth exploded in the US, but we also saw really high inflation. This is because people could take on debt really easily. They could save hundreds of dollars on a loan, and it would be just really cheap for them to take on a debt. The same thing with consumers in our economy. People could go out and get a mortgage and an auto loan and spend on credit cards super easily, but now in 2022, it's a lot more expensive to take that debt on because interest rates are going up, and now people are just not investing as much as they were over the last couple of years. Businesses are losing money. They're having to cut costs by cutting people, and well, that's going to have a significant impact on this September, because now, as September is already a really bad month for stocks in the US, this could be even worse, because if the Fed gets really aggressive with inflation, businesses are all of a sudden going to have to cut a slew of people, contributing to unemployment and possibly a recession in the US, meaning the stock market could, well, potentially go way down. And the last date that you need to pay attention to in September is the third and final reading of our Q2 GDP in the United States. The first and initial reading of our Q2 GDP showed that our GDP actually shrunk by 0.9%. That was all the way back in July. In August, though, we had the second reading, and this reading was revised downward, a really good thing for our economy. It was revised downward by 0.6%, so it's going downward. Now, it could go either way. It could be revised back up, it could be revised back down, but this is going to be crucial to figure out if our economy is, well, going to be in a deep recession, or if we actually have some growth, or if things are flatlining, and that's going to help the Federal Reserve on their next meeting to decide what to do with rates too. And it could give us a little bit of a window on what's going to happen for Q3 2022, if we're going to have massive losses for the month as well, or if things are going to be flat and starting to grow again. That third report is going to confirm it because it's the last one that they do. They typically look at our GDP in 3 separate months, the month that the quarter ends on, and then the following 2 months. Depending on what the numbers are, that's going to show us if we're in a recession or not. So yeah, this month is going to be very wild for the stock market as they prepare for a potential recession, they prepare for job cuts and just cutting in general, and they prepare for the Federal Reserve and inflation possibly going up or down. But now I want to hear from you on this issue. Are there any dates that I missed? Go ahead and drop them in the comments below. And of course, what do you think about all of these dates for September? Do you think that this September is going to be a really bad month for the stock market, or are we going to break the streak and this September is going to have big gains for the stock market? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.